You guys should now see my home screen. Just shoot me one more yes in the chat. I know we're asking for a lot of confirmation in the chat. We're needy over here. But just shoot me one more yes in the chat if you're now seeing my screen up there. All right. Perfect. Good. Bob said no. Everyone else is saying yes. So Bob might need a little assistance, but it should be right there on the main screen.
I think you actually added mine, Nathan. You added mine, not yours. Hold on a second.
Well, there you go. Just kidding, guys. There we go. Oh, we're hitting at the same time now. There we go. All right. Just kidding. Same screen. All right. Let's do a quick review of our closing playbook. Had another awesome crowd on closing playbook. Thanks, everyone who jumped on that. That was a lot of fun. We love trading earnings when we get the opportunity to do that. Had a couple nice ones come in. Obviously, like I said, those are kind of lottery picks, as we would call them. They're high-risk picks. But we took two. The first one was TTD. We took puts or a put spread on TTD. I mean, I wish I just took a regular put. In a rare situation, I wish I would have just bought the puts because TTD absolutely collapsed. It's like a negative 35% move on TTD, which actually did two earnings sessions ago, and I was holding stock, which I didn't enjoy, but it was nice to get that one. Now, I actually got exercised, or signed rather, on the short side of my TTD. I'm not sure if anyone else did, but I did actually get the assignment. And so I just went ahead and exercised the other half this morning for a full max value on TTD, and happy to have that one as a nice winner. Then we had XYZ, which we traded to the upside, and that was a nice one as well. Huge pop up to 87. It did pull back. This chart doesn't take into account the fact that it pulled back a little bit further this morning. So I'm not sure actually what XYZ is at right now, but I think we're still pretty well clear above our line in the sand there.
It faded this morning, 78 now.
Okay, well we're at 78. It had faded but stayed up to like 81 or something. Yeah. So we're now right on the line. This one looked amazing on the first earning. It literally popped, 10% clear of our level and then faded. So if you already closed it with some profit first thing, great. If not, I'll just keep an eye on it. And then if it's still close to around the strikes, I'll set a target on it later in the day. But two really good pops there immediately on earnings. All right, now this is the weekly chart on the SPY. Get ready to use that chat again because I'm curious. What do you guys think? You think that this week is just shaking off that blunder and that ugliness and we're right back to grinding higher? Or do you think this is a fake out? Do you think this is to get some more buyers on board before we flush back down and have our real correction down into the 600 levels? What do you guys think? Just type shake off or fake out in the chat. Let me know what you think. And again, this is the weekly chart. So we're seeing a pretty broad view here on the S&P 500. And we obviously had that really ugly week last week, a couple, negative 1.5, 2% moves. And then pretty much starting from the weekend, you can see the weekend popped and we never gave a penny away from the weekend pop through the rest of the week. And now we're actually even a little bit higher that my screenshot doesn't take into account. So we got a pretty good mix here of fake and shake. Okay, good, interesting. Pretty good mix. Well, I'm going to walk you through where I think we're at just overall. And like I mentioned in Telegram, I'm actually going to come down on the side of I actually think we're in a pretty healthy spot. And healthy is a weird word to use because we are, quote unquote, overextended. We're in this squeeze. The true economics of the reality of our economy and the stock market economy are still divergent and don't really make sense. But yet, all that said, where the market is right now, I still think we're in a decently healthy spot. So we'll take a grind through that here. Let's first of all look at last week's sector performance when we got that flush. So this is last week, that ugly, if I go back here, this red candle, this is really how we got there on the sector view. And you can see most of the sectors were down between 2 and 4%. If you guys remember, I had told you last week, I thought this was a relatively good sign in the sense that we're not getting a break in one of the sectors. We're not seeing XLK and communications down 5%. We're just kind of seeing a liquidity flush across the board, which made me think it was more of a pullback than an actual rotation. And you can see, again, XLE, XLF, XLV, like XLC, they all were in a relatively tight range of 1% to 2%. We didn't see 5% and 6% moves other than some earnings bombs on XLY. And, I wasn't especially worried about those, which I went into last week. You can go watch the recording from last Friday if you want to go through that. And what I mentioned was that I thought that the ones that were kind of middling here, that were 1% and 2%, XLK, XLC, XLP, would probably be the ones to watch for this week. And we actually got really good responses across the board with the sectors, for the most part, grinding up. Now, what I'm shocked about is that XLY actually totally rebounded, which I would not have said, like, hey, go all in on XLY. It's the one that's going to rebound. I would have been very careful with XLY, but we actually got a phenomenal rebound. That's consumer discretionary, by the way. So when I say XLY, I'm saying the consumer discretionary sector had a really strong bounce back after an ugly week last week. And then you kind of see these middling sectors, like I mentioned before: staples, technology, communications, utilities still stayed above flat, financial stayed right around flat. And so we actually have, again, a relatively healthy mix of stocks that are grinding us back to the upside. Take a look, for example, at the spread of high performance and earnings beats that we have across the different sectors. So on XLY, we have stuff like Dash, which is a pretty speculative asset that's going to have big swings, earnings hits, stuff like that. But then we also have a mix that, while they're in the XLY holdings, they're really solid stocks like AZO, that's AutoZone, Lowe's, Home Depot, which actually I didn't even snapshot, is up, Tractor Supply. So, a really good mix there. Then you go into XLK, and we've got our really high flying tech stocks that are killing it, all the way from Palantir and ANET, which, wow, do I wish I held on to ANET. What a monster that's been. Down to sluggish ones like Apple that have been lagging behind, that are $3+ trillion market caps catching up. And then AVGO continuing to grind. AMD, which I grabbed, up a lot. So XLK throwing some nice winners across the board. Then you get into something like staples, which really shouldn't have the same kind of, big winners that technology has in the same week. And what do you know? You've got a whole bunch of solid, steady winners like Dollar General and Walmart and Kroger. Even Target, which has been a dud, has had a good week. So we're seeing nice, solid outperformance, both in terms of steadily grinding and earnings beats across staples, across discretionary, across technology. And so we're getting a really nice, even mix of winners across the board. Now, one of the things that's the positive is one of the things that still makes me nervous. I've been talking about this since March. The insider buying completely missed this move. And it just makes me nervous because the insider buying is usually one of the best indicators of long-term recovery. After you get big 25% flushes like we got from March to April, you would expect the insiders to step in and trigger that long-term recovery, because usually CEOs, CFOs, those guys are buying big hordes of stock when they're positive on the outlook. And we never got that. So that's kind of the thing that makes me nervous in the monster recovery that we've had. If you go back and look at 2020, you can see how outsized the insider buying was. Everyone see that? So the blue line here is insider buying. The red line is insider selling. Now, usually selling is always higher because they take huge portions and then they liquidate stock over time. And so you're always seeing more liquidations. But when the market is really down and you're kind of signaling the bottom and people are readjusting for long-term potential, you would typically see this insider buying spike. Everyone see this? How high it spiked in March of 2020 here, where all of a sudden the CEOs, the CFOs, all of those guys were saying, listen, the market just flushed 30%. but things actually look good for our business, which no one knows until it's public information later. And they went on a rampage of buying. You see that here in 2020. And then here in 2008, same kind of thing, right? Markets were ugly. Business was ugly. The economy was ugly. Everything was ugly. But right at the end of 2008, before it made its way into the stock market, insiders were saying, hey, things are actually starting to turn around for our business. The recovery is on. And so they started buying up huge amounts of their own stock, projecting that long-term recovery. And we simply never got that in 2025. So that's kind of the thing that makes me nervous. Now, on the flip side, one thing that's very clear is that the big boys are betting on the big boys, right? So the insider volume, we're not seeing mass amounts of buying like I would have expected us to see after a 30% hit, but we are seeing the big institutional volume come in. For example, here's the option volume from last week, okay? So on the bullish side, we have all the big boys. The Qs, the SPY, we have NVIDIA, Amazon, Apple, Tesla, TSM, Palantir, a couple smaller ones as you get way down here. AMD had some action. And on the put side, we have small caps, and then we have some probably hedges on NVIDIA, SPY, and QQQ relative to the buying. And then some other ones like SMCI and smaller amounts on the bear side. This week, more of the same. We have Apple right at the top, $41 million in volumes going to their earnings. We have NVIDIA, SPY, Tesla, Amazon, AMD, AVGO, couple little guys in here like Snap, but for the most part, the big boys are betting on the big boys, right? Now, if you look here, there's kind of an interesting hedge here. If you look at it on the other side, this is RSP over here. Does anyone know what RSP is? I'll give you a second in the chat. Anyone know what RSP is that we see at the very top of our bearish flow here with 6.1 million this week on the options? Yep, Sue's got it. Yep, you guys got it. It's the equal weighted SPY. So what you're seeing is $10 million coming into the SPY, but actually $6 million short in the SPY. What you're probably seeing here, folks, is someone putting on an institutional hedge where they're saying, listen, I think the SPY is bullish, but the equal weighted will probably underperform the heavily weighted because the big boys are going to win. So what they're probably doing is like a margin arbitrage trade here where they're looking for the equal weighted to underperform the regular weighted, showing that the big dogs are likely going to be the ones that drive the SPY if we get outperformance. And at the same time, if the SPY drops, it's probably going to be the dogs that drop further. So kind of an interesting play that we're likely seeing here with this flow. Outside of that, like I said, a lot of hedging, but the big dogs are in there. Take a look at the equity flow from last week. It's all index and big dogs. You've got SPY, IBV, that's a 500 ETF. You've got NVIDIA, Tesla, Apple, Amazon. Again, you go through JPM, Coin, AVGO, Google, Microsoft, all the way down. You do have a couple, UNH, not a monster. That's probably the only non-monster on the entire, I guess Coin. So UNH and Coin would be the two non-monsters in the entire list here. Interesting equity flow this week, similar, almost the exact same flow, but look at this. We got massive corporate bonds. And I don't know if this is just because of the Wall Street rotating seasonally or something else, but I've never seen that level of corporate bonds flowing all at the same time the same week. You got a massive 3.5 billion on VCASH, 2.5 on VCIT, 2.4 on LQD, another 1.3 on HYG. These are all corporate bond ETFs that are getting massive flows. So that's interesting in a couple ways. Number one, it's just interesting that maybe there's a rotational thing happening there. But number two, it shows that we are looking very optimistic again, on those massive corporations, because companies should only be taking corporate debt on if they're confident in the outlook of those corporations, right? They should, first of all, the corporations themselves should really only be taking on debt if they are taking on growth debt, because, these corporations aren't typically taking on debt because they can't make payroll in the S&P 500. They're typically taking on debt for growth and upside. And then the companies that are buying that debt are buying it because they obviously have a positive outlook, and they're buying that debt through those assets. By the way, if you look at those assets, Graham, I don't know if you've ever traded these. I really haven't. If you look at those assets, the charts are pretty phenomenal on those corporate bond loan charts. Like, pull up VCSH, great looking chart.
I'll take a look.
Which I've never traded directly. I've just seen them kind of pop up in the rotational, equity.
Yeah, I think they are good looking charts for the most part, but they just don't pay a lot.
Yeah.
So VCSH has gone mostly up for the last 2 years, but it's up 5-6% over 2 years.
Well, I heard that what a lot of people will do with it is they'll do like the income kind of play, like either the wheel or something like that on those. UEC. I mean, don't get me started on the nuclear. I think we've got a huge opportunity on still to go. I think we're still in the early phases there. All right, let's move on to our lesson of the week. Now, I gave this lesson of the week not too long ago, but I got a flood of questions about it since then, and I think it's really important. So I'm going to go through it again, and then I'm going to show you something here at the end using weekend options, which I'll talk about because our weekend options trade is just a couple hours away, and I know that not everyone has jumped in on weekend options yet. So we'll talk about that here in a minute, and I'll relate it to this lesson on stop losses. So make sure you stick to the end, because I'm not only going to show you an example of it, I'm also actually going to pull up the track record and walk you through the impact of this kind of more at scale. So again, this is one of the most important things for me in the structure that we trade. I'm trying to give you guys a framework. I'm trying to kind of walk you through over time here why we use the structure, the benefits of the structure, how to understand risk reward, why we use targets in many instances, what happens on early assignments, why we don't use stop losses like we're talking today. And my hope is that over time, you guys really develop a full understanding of the structure and the math part of this that most people just never learn. Most people chase hot stock picks their whole lives and never really understand structurally, how to take advantage of the market. And so I'm really hoping that we're getting more and more and more into that vein over time through these opening playbook, closing playbook, and all the other stuff that we do. And this is really one of those fundamental aspects of the structure. It's why I don't use stop losses. So there are 3 main reasons that I don't use stop losses. Number one is that it's just too easy to lose. If you put a level out there in the market that says, please take my money, please cost me money, you're basically begging the market to do that. And so I really try to avoid that. I don't want the market to have an easy way to take me out of trades. If you are dead set on using a stop loss, which I'll explain why I really don't think you should be, but if you're dead set on using a stop loss, then I would recommend you have an alert on the underlying stock and use that as your reason to get out rather than having an actual stop loss on the option, because I think you're just asking for trouble. By the way, this is the exact opposite reason I love using a target. I love having a level out there that says, please give me money. Anytime the value or even the bid of the ask moves enough to give me money, by all means, take me out of the trade, pay me, and let it happen automatically. So the same reason that I hate stop losses, I do love targets. We'll obviously get into that in other lessons. Now, the other thing here is that I want to use time to my advantage. That's very, very important to me. And again, I'll give you a specific example of this on a real trade here in just a minute. But if you want to use time to your advantage, in other words, I talk about that window of the trade. You want to have a window. You open the trade, then you have an expiration. You want to use that window to your advantage. Well, you can't do that if you have a stop loss. Why? Because if it drops early, it's going to take out your stop loss. So think about it this way. You open a trade this morning for today's
I don't know if it's just me, but Nate, you may have muted yourself.
Yeah, he is. I was trying to unmute you from here, but it's not letting me.
Oh,
Something just went down. There you go.
I think it's because I bumped my microphone and it thought that that it was this mute button. Anyway, that's little awkward. So I have no idea where I dropped off there, but the second reason was that I want to use time to my advantage. So I want that window of time where I'm giving the market an area to make the move that I want it. So if you think about it, if you open a trade right now at 10:30 with today's expiration at 4 p.m., you're going to have 5.5 hours, right, to hit whatever you want, whether it's a target or finish above. And so you're basically giving the market that time to make your move, which I think is one of the biggest advantages in the market, because over time, things generally move up, especially if you're trading good stocks. Whether it's 1 hour or 100 days, the principle is the same. The more time you give it, the more your advantage is within that framework. So if you give it 5.5 hours and then you put a stop loss on it and it drops the first half hour, well, now you just took the other 5 hours off the table. You're no longer giving the market that time to move in your favor. So that's another big reason. And then the other one, and this is the one that I think most people don't realize or don't take into account, is that the risk to reward changes. So the actual risk to reward as the value changes, or as the value moves in your trade, fundamentally changes. And people don't think about this in the correct way. So I'm going to walk you through that and hopefully give you a bit of a light bulb moment here for how risk to reward actually changes as we go through a trade. So let's go through this. Use the chat if you have questions, because I really, really want you guys to understand this. It's hard sometimes conceptually to kind of get over the hurdle, but I want you to understand this. And if you have questions or you're not understanding something, just use the chat, and I'll try to make sure that we hammer this home. Okay, let's go through it. So let's imagine that you take a trade here. You have a line in the sand here, meaning that you want the price to stay above 205. That's a winning trade in your scenario. Then you add an expiration date here. Okay, so let's say that's a week later. You paid $4 for the trade. This would be something like we do in the income machine, where you now have $1 of potential reward. Why? Because if you trade a $5 spread and you pay $4, the most you can make is the other dollar left in the value of the spread. So that's a 25% ROI. Let me pause and ask if everyone understands the concept of the trade. Okay, don't worry about why we chose this trade for now. Just make sure you understand we want the trade to finish above 205. We risk 4. We can make 1. It's going to expire. If it expires above that level, we make the dollar. If it expires below both levels, we lose the 400. Just conceptually, that's what the trade is. So let's then run through a scenario of how the market might work. Okay, because remember, the value of the trade is going to change all throughout the trade. So let's say on day 1, the market moves up a little bit. All right, well, now your trade just gained $10 in value. You made $10 on your open liquidity. Obviously, you're not closing anything out, but now your risk to reward just changed. Why? Well, because it's up $10 in value, which means there's only $90 now left of profit potential. You started with 100. Now there's only 90 more that you can make. At the same time, your risk has actually gone up. Your true risk has gone up because you started the trade with $400, but now you have $410 of risk because that's what your net liquidity is. Okay, now let's say the market goes down a little bit. Day 2, it drops and you lose $50 of value from day 1. Well, now your risk that you have on day 2 is actually lower because that's the value of the current trade, and your profit potential is actually higher. Weird to think about, but that's the reality. Let's say day 3, it continues going down. And this is where a lot of people will ask me, should I get out of the trade? And the reason they're asking that question is because they're thinking, the trade is losing. I risked 400. I'm not sure as it goes down against me that it's worth making the $100 on the trade. And what they don't realize is that they're no longer risking 400 to make 100. In the current setting of the trade, they're actually risking 290 to make 210. And that's really hard for your brain to understand in trading because you think of it as a trade setup. But in reality, what's happening on day 3 here as the trade comes down is that you're still above the line in the sand, but your risk reward is now closer to 1-to-1. And again, guys, use the chat if you're not sure or you're confused. Let's work through this together. But this is what's the reality of what's happening. And so when I respond and I say, no, I don't get out of the trade here, it's because the risk reward parameters based on where the trade is actually at have actually changed in real time with the trade. And if you go a step further, now the trade's down $110. Now my risk reward has changed dramatically. Because if the trade is now down $110 more, I'm no longer risking $400 to make 100. In this current situation, in real time, my risk is actually $180 versus my potential reward is $320. And so again, when people say, "Oh, Nate, the trade's down, should I get out?" A lot of times they're thinking it's not worth it to make $100 here. The trade's not even going to likely win. They're right; it's not likely to win. It's not worth $100. But there's not $100 worth of potential. There's $320 worth of potential. So if the trade is still valid and I like the stock, it wouldn't be worth it as a 25% ROI in the current situation, but it would be worth it at a 200% potential ROI. And that's what the actual potential is. Now I'm getting into the weeds here. I know for a lot of you guys, you're like, Nate, just tell me the trades and what the probabilities are. But I really want you to understand this because this is so important to how you evaluate every trade that you're in real time. Now, why is this the reality? If you guys are still struggling with why this is the reality of the trade, all you have to do is think about it based on your net liquidity in your account, the actual, equity of your account, and it should make more sense. So if you think about it, let's say that you started with $10,000 and you risked the 400. Okay, so you put the risk of $400 in your on your account. Now your account balance could go down to $9,600, right? You're risking 400. But if on day 2 the trade is up $50 and the equity in your account is not $9,600, you don't have $400 of risk. Your equity is actually $10,050 because the trade's up. So that's now more money that you're actually risking. How? Well, think about it. I'll even type it in the chat for you. Your equity equals $1050, but your risk is how you set up the trade where the account could go down to $9,600. Right? You have a legit $1050 in value, but remember, you set up the trade at a $10,000 account risking $400. So if you lose, your account's still going to end up at $9,600. So someone tell me in the math, is that $400 of risk or is that $450 of risk? It's $450 of risk. That's the real risk. The same thing is true when your equity drops down to $9,800. All right, let me just type it in the chat. If the equity in your account is equal to $9,800, but remember, your risk still takes the account down to $9,600 when you lose, is that $400 of risk or is that $200 of risk? It's $200 of risk because you can't base it on where you started 3 days ago. That's not real money. What's real is the value that you have now. But think about it on the flip side. Let's do it again. Let's say the equity is equal to 9,800. But remember, the target, if you win your trade, isn't 9,900. It's the original setup. So your account will be 10,100. So then you got to answer it again. Is that $100 in gains from where you stand right now? Or is that $300 in gains from where you stand right now? It's $300 in gains. So you have to readjust where you are based on where the actual trade is. And if you just do that, then it starts making a lot more sense why it often makes sense to hold a trade. Now, of course, your probability is changing with the trade too. This trade, when it hits down here, has a lower probability of winning, but does it have a lower probability relative to the risk reward? That's what matters. We would call that like pot odds if you were in poker. And that's really where things come into play. And the reason that my default is to leave the trade open is very important. Don't forget this part, guys. I am trading stocks that go up more than they go down. Okay? So I am trading stocks that go up more than they go down. So time is at my advantage. And what often happens is just like this, right? How many of you guys have seen this? Went down. A lot of you guys with the income machine did this. You saw a trade, it went down. I said, I would give it more time. You gave it more time. It turned from what would have been a loser into a winner. And by the way, the cool part is now, even when the market goes sideways, it's still adding value to your trade because time decay is working on your behalf. This happened, by the way, in AMD. If you guys had an income machine on AMD, it looked like a loser. It flipped right back to a winner simply because this happened. It moved below your line in the sand. Then it moved back above your line in the sand. It's a beautiful thing when it happens, when you see time work to your advantage. But understanding the risk reward is the actual fundamental reason that we do that. Then maybe day 12, you exercise for a full profit in a trade that would have been down 60% or 70%. Now is a full profit. And from the peak bottom to the peak top, like I said, you didn't make $100, you made $300 or $350. And so this is why I do not use a stop loss. Now, the big question is, Nate, are you saying that you're willing to lose 100% when you're wrong, or are we missing something here? Is there some line in the sand that you haven't talked about? The answer is yes, I am 100% willing to lose 100% in almost all my trades. Now, there's some trades where I use other things, but in most cases, I'm happy to lose 100%. For me, that's actually one of the best parts of trading. I can use this structure to have a defined max risk and give it all the potential time to hit the target and finish on the right side of the line, or like I said, bounce up and hit my target. The willingness to lose 100% actually gives me that, that ability to give it the max time. Now, let me give you a crazy example from weekend options, because that's what we're about to talk about. We have our trade coming up here in just a short period of time to walk you through how this actually works, giving the trade time. Remember, you can only give it the max amount of time if you're willing to take the max loss. That it goes hand in hand. I can only give the trade all the time needed if I'm willing to take the max loss. The beautiful thing about the options we trade in basically every service or strategy is they're relatively cheap. So you can choose a risk that you're comfortable with. You can risk $100 or $200 or $400 or $1,000 or whatever, because you can define your own risk. So let me give you an example. On March 28th, I was playing Pebble Beach when we got our weekend options alert. Now, does it matter that I was playing Pebble Beach? No, this is just an easy excuse for me to once again reference the fact that I was playing Pebble Beach. By the way, I missed that putt. In case any of you guys were wondering, it was about a 30-footer. I did not make it, but it was a cool picture. And so I kept it in there. And so while I was out there, literally on Pebble Beach, we got our alert. It looked just like this. Friday, March 28th, buy to open the 554 call, sell to open the 556 call, set your price at this level, set your target at this level. These alerts are really nice because they're simple, they're systematic, they give you the entry and the exit in every single alert. And then here's what the chart looked like. If you guys remember, this was the end of March fade before the Liberation Day, and the market was tumbling down. Stanley said, nice humble brag. I didn't even think it was that humble. It was mainly just a brag, Stanley, but I'll count it as a humble brag. But I'm just joking. So here's what the chart looked like. Here's what the chart looked like. You guys remember at the end of March, we were ripping down. And so here was the trade structure. We had a 556 call right around the current price and a 554 below the price. And so we needed the market to stay above the 556 level. That's how we win this trade. Well, here's what the market looked like when it opened Monday, March 31st. Not exactly the open that you're hoping for when we want the weekend to stay steady. It was basically a full 1% gap down. All right, so again, we took the trade here. We need the market to stay above this level, and this was our Monday open. Talk about an ouch. The position was down like 85 or 88%, right? So obviously, any stop loss you have would be taken out. A 50% stop loss, even a 75% stop loss would be immediately taken out. But by being willing to give it the max amount of time, we're saying, hey, we're going to give you the rest of the day here to get back above the line in the sand. And I use the total risk as my stop loss. And so that's what this one needed. At noon, even though it started moving up, it was still down like 80%. So even though it's moving up, we're not gaining much value because we're also fighting time, right? So it's still saying, yeah, it's moving up, but you're 0.5% below your line in the sand with, 4 hours left. There's still almost no value on this trade. Even as it climbed, it was still down late into the day. Same thing, right? Yeah, it's moved up a good bit, but we're still down 0.25% below our level. Actually, more than that, about 0.3% below our level at 2 p.m. So this trade was still down like 80%, even as it climbed higher. But then it went from dead in the water to a full profit target just a couple days or a couple hours later. So this is in the course of one day. Down 85, down 85, down 80, down 80, down 80. Oh, closer, down 20, down 30, boom. Target turned a losing trade dead in the water to a full profit by the end of the day. Why did that happen? Because I used my debit spread as my stop loss and said, listen, anything I do to manage this trade, I'm going to take away time from the trade. I don't want to take away time from the trade. I want to give it the max amount of time to hit my target, and that's what it needed on this trade. Now, does that always happen? No. Usually when a trade is that dead, it does lose, but it's those couple of times that flip from losers to winners that really change the dynamics. Okay, so let me ask again, does that make sense to everyone? Does the idea that you're actually going to use the trade as your stop loss, whatever you want to risk, you can risk, but then give it that max amount of time and say, listen, the more time I give it, the odds go higher and higher and higher in my favor. Now, they're not great when a trade goes against you, obviously, but you'll take the edge that you can get. That's one of the edges that we bake into the trade. Okay, let me show you an example of this with our weekend options looking at the last 20 trades. Now, the screen is probably not huge, but I'll try to scroll it up here and make it so that you guys can see it as clear as possible. So over the last 20, weekend options actually has 20 wins and no losers. So I can't really show you a losing example. But what I would do is kind of give you an idea of how the math actually works out. So let me scroll down here and let's assume that we take 100% loss. Well, if you take 100% loss, then we would go to 20-1. Our profit factor is still about 4. That's pretty darn good. Everything else, great metrics. Now, the crazy thing is here, I could actually take like 300% losers. If I did that, the profit factor is still positive even after 300% losers and the win rate going down substantially, right? So that alone shows you that you can withstand 100% losers with the right amount of, winning to balance it out. Now, if I go to 2 losers, I'd be at a 91% win rate. Our testing shows more like 94%, but we'd be at a 91%. We have a profit factor near 2. We'd be racking up some pretty nice gains. Now, here's where it gets a little wild. Because remember, and this is what's important, if you're doing a stop loss, what you're doing is you're trading some of these winners for losers. In fact, there's like 3 or 4 already that would be losers. So what I'm going to do is I'm going to take these other 2 losers out. We're going to go back to our 20-0. And let me show you a couple of the trades that would have been losers. So this one, if we did, let's say we did a 60% stop loss here, you turn a winner into a loser. This one, you turn a loser into or you turn a winner into a loser. And then let's just say we turn one more into a loser. Okay. So what happens there is that our profit factor on those three just went down to 1.78 by turning those winners into losers. Now, here's what I want to show you. This is pretty crazy, guys. Think about this. I know I'm a math nerd and you might not appreciate it as much as I appreciate it, but just think about this for a second. I just showed you adding two 100% losses with a 1.9 plus profit factor. Then I put in three 60% losses, and it hurt worse than the two 100% losses. Okay, so just think about this. Minus 200% equals 1.95 PF, but 360% losses, which is 180%, equals 1.78 PF. I'm going to type that in the chat just so it's more obvious. The power of this is that taking more total losses, but not trading wins for losses, actually gave us more profit. Pretty crazy, right? You would think you take any system, you reduce the cumulative losses, you're going to be net ahead. But actually, because we're not taking winners off the board, we're only taking losses, and then any winner stays as a winner. We actually are more net profitable with 200% in losses than we are with 180% in losses, because it's 360% losers versus two 100% losers. And that's actually exactly what the data showed. When I ran these weekend options every which way, it showed, listen, giving it the max amount of time and making sure that every winner has a chance to be a winner, and you take full losers when they lose, is better. Now, the cool thing about weekend options is that we actually don't take full 100% losses in every situation, because often the losses that we take are partial losses when the market flips, to a situation where it's near the strikes at the end of the day, and we end up taking like a small 20% loss or 30% loss just to get out at the end of the day, where we still did give it the max amount of time, but we got out at the end of the day. So if you guys are not sure exactly how all that adds up and works, Dave's going to play that weekend options presentation for you directly right here. But hopefully you guys had a couple light bulb moments. Give me a yes in the chat if you had a couple light bulb moments across the board here with how the risk reward changes, why time matters so much, and then hopefully that weekend options example just giving you a very practical example of why 200% in losses actually performs better than 180% of losses when you actually put it in real trading, which in our case in weekend options is 100% win rate so far. So good. Okay. Jimmy, Wayne, Paul, Debbie, Chuck, Honey Badger, Bob, Richard. Great.
I love the person who tuned in with the name Doofus. That's cracking me up.
That was Dave who did that, but I guess not.
I agree with what John said here. Outstanding explanation there. Guys, if you are enjoying the overnight options, who here is enjoying the overnight options? We just got a bunch of yeses. I'm sure we'll get a bunch more. If you're enjoying the 60-minute income, hopefully that one's mine. That's my baby. Hopefully you guys are enjoying that. If you have any fun trading either of those, you will absolutely have a blast with the weekend options. It's just another tool to add into your arsenal. It's an amazing, Nate, when we look at 2025, one of the more volatile years for weekends in the history of the stock market, yet 100% win rate. Now, obviously, no one's going to go win 100% of the time, all the time, but your testing showed 94 or something like that percent. Very, very, very high win rate. 100% win rate. There you go. Miranda said so far 10 for 10. That's on overnight options. Catherine loves weekend options. So, guys, this is definitely one of those really, really fun trades, really, really profitable trades you want to have in your toolbox.
Yeah. Obviously, I get nervous every time we keep talking about the 100% win rate. I don't want to jinx it, but it's been awesome. And the cool thing is like Graham said, the data is really robust. So, I don't expect to win 100% all the time, but I do expect a super, super high win rate. And it's been really cool to prove it in real time with the live markets so far. So, yeah, take advantage. Obviously, no pressure, nothing like that. But if you want to get on another, just another tool in the tool chest that has been phenomenal, would love for you guys to take advantage of weekend options. Our next trade here is literally just a couple hours away. We're going to try to keep that win rate alive. So check this out. Stay right here. Don't go anywhere. It'll play right from the screen that you're on right now.
All right, folks, you're going to have to turn your volume up just a little bit. The audio on the thing we're about to play is a little bit lower than we've been up till now.
Especially, Nate, in 2025, we've seen some insane weekend volatility.
Mm-hmm.
Unlike 2024, 2020, like we had not seen that for years. But you're up 100% win rate so far in 2025. Love to see it. Well, if that's you guys, you want in on the action, well, it all starts by taking a close look at this redacted document. What you're looking at here is a special perk set up by the Chicago Board of Options Exchange just recently. It's a perk that now allows everyday folks to target extra